So I'm just going to do a quick primer on reviewing financial statements before we proceed to this month's report. The balance sheet shows the asset and liability accounts, and most of these accounts are really very similar across our sector among most of the nonprofits. The asset accounts are the things that the organization owns, so that's the bank account, your tenant receivables, investments, buildings, and depreciation. Liability accounts are the things that we owe other people, so accounts payable, the mortgage payable, tenants' last month deposits, those types of things. I've been teaching people how to read financial statements for over 30 years. And through all of that time, I have been telling people how important the balance sheets are. People tend to understand income statements, and they tend to avoid the balance sheet. But the balance sheet tells you what your current situation is from the time the organization began until now. Income statements only tell you about 1 year. And frequently, in order to do good financial management, you need a full historical view. So it's really important to review the balance sheets. I just cannot impress upon you enough how important it is, particularly in our sector where we have huge assets that we have to manage. So the balance sheet, a good review of the balance sheet makes certain that the assets are being protected, and it will catch problems that affect the income statement. So when you look at the balance sheet, you need to go through and do a monthly review. And I think it's really important that you compare the account balances for a number of months. So I always prefer to see balance sheets that at least have the prior month and maybe even the end audit balances for the prior year. You're looking for unexpected jumps in account balances. You don't tend to see these in balance sheets. So if you've got them, then you want to pay attention. Trends that may point to problems on the income statement. So that would be, big increases in the receivables or accrued accounts that don't seem to be being adjusted monthly. And you need to identify those things that are going to affect the income statements. I've actually seen this over and over and over again, where boards have been reviewing income statements. They think they have surpluses. The audit gets done and they end up with a major deficit. And that's because they haven't been looking at the balance sheets and not evaluating what's going on in them. So there's some questions you should be asking yourselves every time you look at your balance statements. One of them is, are your capital replacement reserves funded? You'll notice on your balance sheet that there's a replacement reserve fund in the assets and there's a replacement reserve fund in the liability accounts. Those two funds need to be the same amount of money. That's required by our operating agreements or under the HSA. You also want to look and see if you have too much cash or too little cash in your bank. If you've got too much, you need to be moving cash into investments. If you've got too little, you need to figure out how you're going to resolve that problem. The board has a liability for payroll deductions for staff. So one of the things that you want to ask at every board meeting is whether or not the payments have been made to CRA in order to protect yourselves from that liability. The other big problem that providers regularly have is that they don't reconcile their subsidies owing to the service manager. There are a number of things on our subsidy payments from the service managers that are estimates that we work on and that have a huge impact. So, for instance, we give the service manager an estimate on what we think our RGI revenue is going to be for the year. If it's lower or higher, that adjustment is generally made with the AIR at the end of the year. But we need to be making those adjustments on a monthly basis so that we know exactly where we're at. The balance sheet tells us whether or not we're going to have cash flow problems. If we don't have sufficient cash to cover our payables and to cover our mortgage, we're clearly going to have a problem. And the other big item for us is always tenant receivables. So we need to be watching it, whether it's going up, whether it's going down, and also what's happening with the allowance based on that, whether it needs to be increased or decreased, and therefore our bad debts adjusted. The income statement is what most of you, I think, are familiar with. We all have our home accounts and basically every year have to figure out whether or not we've got enough money coming in to cover it. And that's what the income statement does. It's the revenue and it's the expense accounts. They vary a lot among nonprofits, but mostly ours will have rents, subsidies, interest, non-rental revenue. On the expense side is things like telephones, salaries, maintenance costs, education costs, also replacement reserve costs. The act that we're under requires us to put aside an annual amount for the replacement reserves that's expensed. So like the balance sheet, you want to do a monthly review. But in the case of the income statement, you want to compare it against the budget that's being approved by the board. And you want to compare that on an annual base, and you want to compare it on a monthly base. And you want to look at every account. Don't ignore this. So you're looking for unusual variances between the budget and actual, either positive or negative. They shouldn't be either way. If you have a huge positive balance on your budget, you want to know what you planned to do that you're not doing. So it's just as much of a concern, and you have every reason to expect from your management that they will have an explanation for these kinds of large variances. You're looking for unexpected trends. For instance, we're currently dealing with a problem where our vacancy loss has been increasing, and in the past we've not had a problem with that. And you want to look to see what the projections are for the end of the year, whether you're expecting a surplus or a loss. And you need to make financial decisions to bring it into balance with the budget. So if our utilities are much higher than what we budgeted for, then we need, in fact, to figure out where we're going to get that money from. And that would require us to perhaps reduce maintenance, or don't want to have to do this, but lay off staff, those kinds of things in order to end the year in where we anticipated. Are there any questions about that before I go on to the monthly report? Okay, that's great. So let's move on then to the monthly report. So on the balance sheet side, there are no major changes on the balance sheet for this month. The arrears are steady, the accounts payable are consistent with prior months, and you can see from your statement that the employee deductions have been paid to the CRA.
There seems to be a significant drop in the cash.
Ah, that's a good catch. The cash drop is the result of the payments on the roof contract. We've paid that cash out, but we haven't yet received the funds back from the Housing Services Investment Funds.
Is that why the two replacement reserve funds are not in balance?
Yes, that's correct. The contract has been recorded in the Replacement Reserve Fund, but it hasn't yet come out of the investment funds.
I'm new to the board, but the cash balance seems very low to me. We don't have enough to cover the mortgage payment or accounts payable. Is this normal?
It is normal. We receive our subsidies from the service manager in arrears, so the May subsidy is received on the 1st of June. And on top of that, most of our revenue outside of the subsidy comes from rents, which we also receive in the first of the month. So it's very common to see a low bank balance at the end of the month. However, it's worse than usual this month because we haven't received the transfer yet from the investment funds.
So why is the subsidy receivable increased so much?
The units that have been turning over are being filled by RGI tenants that are taking a deeper subsidy than what we originally had told the service manager. So we're kind of short of subsidy every month for those units.
I don't see why we're carrying the cost of the RGI subsidy. I think we should be asking for an adjustment immediately.
Is that a motion?
Yep. I move that the management should immediately request an increase in the monthly subsidy.
Is there a seconder?
I'll second that.
Seconded by John. All in favor?
Yep.
Yeah, it's carried.
Okay, so we're ready to move on to the income statement. The rental income is lower than budgeted because of the vacancy loss. We've not historically had a vacancy loss situation, so we're now significantly over budget for vacancy loss. Building and equipment is significantly below budget. This appears to be the result of the work we did last year on the building. It seems to be having a very positive impact on this current year's expenditures. There was a mortgage renewal last month, so our mortgage payments have reduced. We are still in a surplus situation, but that may not continue if we can't resolve the vacancy situation.
So why has our subsidy amount changed from last month?
This is the result of the mortgage renewal. It's the payments are less, and so the service manager has adjusted the subsidy.
I noticed that the tax subsidy doesn't match the property tax expense. Aren't property taxes a pass-through on our subsidy?
That's a good catch. I'll ask the bookkeeper to adjust the subsidy to the actual tax payments. I can see from looking at this it'll have a positive impact on our bottom line, as the two of them should be identical.
I noticed that the bad debts have really increased. Why is that?
Bad debts are based on the amount that we assess that the allowance for bad debts should be set at. The board actually has a policy on this that we apply every month, and in particular, the policy requires that we set aside 100% for arrears for tenants that have moved out. And we've had a number of move-outs recently, and they have moved out with losses, so that's why.
Are there any other questions?
Have we heard yet what the cost of the insurance renewal is?
We haven't received the invoice yet. We are anticipating some negative impact from last year's fire, but we did set aside a 15% increase in this year's budget.
Are there any other questions?
No.
Seeing none, let's move on to our next agenda item then.